All right, before we begin, welcome to everyone, and I'm Randy Taylor, and right here beside me, stick your head over here for a second, Jeff, so they can see you. Yeah, you gotta show your face. There you go. All right, there you go. That's Jeff Hussey. He is the COO for my contact center business everywhere, and so he is helping on this, and I want to first tell him I appreciate his efforts, extracurricular, in helping me put this together. Obviously the markets are in a very dynamic period right now, and I'll say this: today we're going to be talking about a lot of the macro aspects of the market, of what drives this market right now, and why we have so much volatility. But volatility is a very good thing. We want volatility. If you've ever been in a bear market, which a lot of you, I'd say about 90% of our participants today have only been trading for about less than a year. And with that type of experience track, you've never been through a bear market, and when you get into the heart of a bear market, there really is no volatility. It's just like an iron pressing a shirt down, and it just stays at a level for an extended period of time, and all the volatility is what creates premiums in options, which, you know, we are very successful in bringing options into our trading strategy for both profit, but for risk management, for hedging, and for locking in profits, all kinds of ways that we use options. So those are beneficial for us now, but if we're ever in a bear, well, we will be eventually in a bear market. And so I'm not going to spend a lot of time on that simply because we're not there, but understand that when we enter a bear market at some point, whether it's this year, next year, 10 years from now, whenever that is, those premiums that you have been enjoying in the options disappear. And things right now that may have an 80-cent spread on a stock that's $2, and you look at that and you go, well, why wouldn't I buy the stock and sell a 80-cent call to juice the returns and give me a 20% return on investment? And there's some I saw out there today that you could do that literally buying them today and they expire next week. And you're making 20% for holding a stock that's around $2 for that period of time. Well, in a bear market, that's a nickel at maximum, 5 cents on a spread. So it totally changes the dynamic. So you are living right now in a phenomenal period of time when the volatility is creating just big movements, macro movements in both stocks, and then because of that, into premiums. The majority of trades that I'll enter is based on a number of factors, and I'll be covering those today. But we also want to obviously spend time looking at charts. And so our purpose today is, just like the seminar said, it's to give a grounding to the approach that I use in trading, specifically things that I look for that I think are replicable, that you can do yourself. And I've already seen that happen within the forum, as well as some people on Twitter that have been able to successfully mirror on different stocks and have told me about them. And I'll look back at the charts, and sure enough, they have starting to master some of the elements that are part and parcel to becoming a very strategic and successful trader. So one thing I want to mention is that because of the number of new people that we have that are newer to trading, the content here is, of course, going to be very much keyed towards that. but I want to let everyone know that's on this seminar, and anyone that is not able to attend that had sent me a note or what have you, that they're going to be able to view the recording later. Everyone here is going to be invited to another seminar at no cost that we are going to get into very detailed on chart tactics, setups that you utilize on your chart. As you see the S&P today, selling off towards the end, creating this nice big parabola that's going on here. Obviously, if I look at the daily on that, oh, how do I get it where I can see if they're looking at my screen? There you go. So if I look at the daily on that, you can see here that we end up with a big stick here, and then it bounced off of the 8-day moving average and closed back down here under the 21. So we never got to the 50-day. The 200's way down here, which is why we had the hedges at 335, because if it flashes anything moving downward, as you people saw that had hedges, the puts, those things rocketed from 251 at the close on Tuesday to over $7. And so that's why you do that. And I'll make a statement about hedges, and they're like insurance. If they expire worthless, well, you pay your insurance premium every month for your home and your automobile. And if you don't have a wreck, or if you don't burn your house down, or your kid doesn't, well, that premium still gets paid, but you get to enjoy all the aspects of that vehicle or that house. Well, that's what hedging is kind of like. If the markets are going in our favor, and all of the stocks that we're in and the trades that we're able to chart and find opportunities to grow our account are happening and working to our favor, then we're paying some insurance premium. And if that premium goes to zero, we're happy. We're fat and happy. But if a day like yesterday happens, and let's say 3% of my portfolio is 1,000 call options or something like that. Yours is probably 2, 3, 5, 10. It could be 100. I don't know what it is, but if it's 1,000 of those, well then, that's a lot of money that offsets losses as insurance premium, and it only represents 3% of my portfolio profits that have come in. And so I'll generally roll profits, and I keep track of those profits. And then whenever I see the market right now, as I told you, as the market hits new high, whenever it hit a new high, after I got really engaged into we are coming in maybe to a point to where we need to be cautious, very cautious. I'm only trading options other than my mass accumulation stocks. I'm not really buying a whole lot of shares unless they're things like Clove or UWMC that I want a long position in, and I'm not really concerned about short-term movement. And I'm also mitigating those with options as well, then I'm pretty thin. And that's what I've been suggesting that people do, is get thin. And, we had people that I saw with massive returns on investment over the past year, and good on you. I mean, that's fantastic. You've made a lot of money, and the person that turned $10,000 into $50,000 in a short 11 months that they were actually trading. And a lot of you were forced into something from your home because you were homebound, and trading became what you looked at, and you either stumbled your way on, or someone pointed you to the stock market thread, and you did very well. Well, that's great, but there are periods of time where you rein it in. And when I start telling you I'm trading only options, you should be building your cash side of things. Is if you're going to follow, not advice, but my mirror of what I'm doing, well, that's what I'm doing. I'm pulling money out of the market as we were going up, and I switched over to options, and I was taking profits and still making profits because the market was still giving us good returns on options. Well, we hit this snag right here, and so there's some uncertainty of what's going to happen. This is a cradle day that you have, and I call it a cradle day because it's literally right here, cradled in between the highs and the lows of yesterday. And the markets are very good at doing that, because how many of you are saying, well, is this thing going to go back down and retest and then keep going down? Or did we set a bottom yesterday and today was just sort of people filling back up? These big institutions are buying, and then there was just simple profit taking on big gains that happened today because of the reversal. Well, I'll tell you, I don't know the answer to that. And I can guess, but that's not how we trade. And so that's why the disciplines are always so big, and that's why right now during this period, you don't want to be heavily leveraged into this market right now. And so I think the markets will eventually move upward and probably crest 4,000 on the S&P, probably press above 4,100. And I don't know exactly where it could end, but until we have some certainty and direction, we're reined in. We use less numbers. If I'm trading 100 calls on a option trade that I'm posting right now, I'm probably doing 40 instead of 100. And if I was going to do 500, I'm going to do 100. If I feel very certain on a certain call option or covered call, or even whatever I'm doing, it's always in a smaller number right now because of that risk reward. Right now is higher. The risk is higher because you have a definitive break in the chain. And that break being that we are right here below this 21-day. So when you set up your charts, you always want to have an 8. I like the 8-day because it encompasses, an overlap from the weekend on those days. But I like an 8-day, a 21, a 50-day moving average, and then down here's the 200. So this is, major correction territory. If we're going to sink and lose basically all momentum in the stock market that's been achieved from this V recovery that occurred and has been going up, then we don't know the answer, but it could come all the way back down. And you saw some dips right here that got close. So is that going to happen? Because that would be fairly painful to portfolios to see something like that. So if we violate this 50-day moving average, then that's something that we're going to be mindful of. So with that, I just wanted to give a quick take based on this close that we had today, because you just never know exactly how we're going to close after a bounce from a reversal that happens. But I would say that this is closer, to something like this over here. You can see back here, this happened where it traded down and then it jumped back up. So we'll have to just watch it very closely, and that'll give us. Now, I'm feeling like that we still have upside room, that the wheels aren't coming off, and that's why I entered the Apple, and it went against us early today, and that's fine. That's why we buy out to February 19th, and we'll talk about options in depth here a little bit later, but not so much concerned about a single day's move that happens in the market as much as we are about what that shows us over a period of days and then over a period of time. So I hope you have your notepads because some of the things that we're going to cover, I don't have them in the presentation as much as I'm going to be talking through those. So we're going to begin with the some charting here because everyone asked me about some of the things that we say in the forum. Well, what does this mean? What's a goalpost move? So here is a stock. I'll move this where I can CIDM. So here is a example of CIDM, which many of us are in net free at this point. But you see back here in September, you had this huge 80 million plus share day. And then we spotted Sorry about that. We spotted, where did it go? That's another one. I just lost my, where did it go? Well, for Pete's sake. Sorry about that, guys. I got to be careful with the mouse. There we go. So we spotted this pretty much on the day that it was happening. I think we found it the next day. So this first day, this was going on, the goalpost, and then we got in on the short pullback that occurred, and then we all benefited from this day that occurred, and then obviously the follow through. So in this chart, I did it again. This chart, I want to zoom. So this chart ends with it at 70 some odd cents, and so we'll see as we look at this stock again what occurred from this goalpost move. But this is the goalpost. You've got a left that's entering, and if I had the full chart, you would see it coming, descending in from a lengthy period of time of dropping, and just really dying in a dead stock. And then you have this major first left goalpost that occurs, and then it just sinks back into oblivion again, and then the right goalpost occurs. So when you see these left and right goalposts, here's the thing that I want you to really pay attention to before you bring them to the forum. Don't bring them in unless you have these items. Number one, you have the full goalpost. You know, you can tell us if it's being created. If you see one that's at 40 million occurring and it's only 11 o'clock in the morning, well, yes, that you're catching the genesis of a goalpost move. Post it, buy it as well, but you're seeing it happen in real time, because if you're at 40 million at 10 a.m., then you know that and you see that volume pouring in, it's going to end way up, and you want to be a part of that. So that's the first thing that I want you to pay attention to. The second thing before you would enter or post it is you look at this huge day of buying, and look at this candle that went up. I mean, it shot up here to almost $1, and then it immediately came back down and just sat and then deteriorated back almost to this low that happened before it shot up. So there's two reasons why that happens. You've got bulls that are getting in the trade. Day traders are getting into the trade because they see it breaking above this recent drop down. And of course, it becomes a trade when it pops here. If you're fortunate enough to be watching CIDM on a day like that, and it pops above this resistance that you saw occurring, then you jump in for a trade. But a goalpost move is all after the fact. And what happens is these day traders get in, institutions are buying like crazy as well, and it kind of masks it. And what happens is the institutions just stop because they don't want the day traders to enjoy those returns for very long at all. So if you're not selling out and you think that you've just bought the very bottom, well, maybe you did or maybe you didn't. But they'll immediately just let it drop back down. But here's what I want you to pay attention to. You have this much volume, and here's that drop that occurred with no volume. There's no one out there that's buying. That's the only reason it's dropping, is because there's no one there to buy the shares from you. And so it's going to fall. So those institutions, they're loading up, and then they're just going to sit back, and they're going to enjoy you suffering for a period, because they don't care about day trades. They don't care about a month. They don't care about 4 months, 5 months sometimes. They are much more strategic, and that's what I've been spending a lot of time with everyone in the forum, is to be disciplined and strategic, because that's how institutions approach trading. They are looking at long ball, and so they are more than willing to allow you to feed them that they can't buy these shares right here without sending the stock higher. They're more than willing to let it just die. They'll pop it up here and let you think, well, here it comes, and then they'll just let it die again. And then they're buying all through here, just slowly, like a cat, you know, eating the canary, just filling up at mass accumulation that is unseen on the charts, because they have months to do it instead of doing it in a day. And then once that's done and it's time to go, you get this initial shot up, and that's a clearing. That's what I call a clear out. So they'll clear out day traders because they'll give a first run that people pay attention to and start buying in, and then they'll let it sink back down. And if you look at your goalpost trades that we've done successfully, you'll see an initial pop that drops occurring every single time. And that institutions are basically clearing the channels, trying to get rid of people thinking, well, they held it all this time and they're worried that they're just going to lose their money, and they get any opportunity to get out and they take it. And that's when it just sinks right back down and they think I missed it. So they'll start selling, and that leads into this drop off here before the initial surge then that sends this stock going. So this is the goalpost trade. There's probably dozens of these every single day. So if you're able to find them and you're able to bring them to the forum, then I and other people can confirm them, and then everyone will benefit. And so it's one of my favorite trades. People ask, well, why do you trade these small stocks? Well, because where else can you get net free in literally a day, many times, or 2 or 3 days, and then have a net free holding to see what's going to happen. So do I look at the underlying of that after the fact or before I enter? Sometimes I do, sometimes I don't. If I don't have time, but I see a goalpost trade, I'll shoot first and ask questions later. So because I know that the momentum is with me on a goalpost trade, and you're going to win more times than you won't. Okay, Model T. This has gotten a lot of people asking, you know, what is a Model T? Well, a Model T is very simply when a stock reaches an apex and or a bottom, but we're going to take this because this is an apex move after a period of time where it was moving up, and then it started going sideways, and then it broke down. And that happened today, by the way, in the on SPY and in QQQ and SPX as well. So it's going along, and it built all day long. And if I had the remainder of this chart, it's down here, and it's come up, and it just kept coming up, and then it broke down. Well, the moment that breaks down, when it reaches a bottom that pivots back upward, then 91.82% of the time, on every time I've charted Model Ts across every stock that I have, 91.82% of the time they reach Model T, which is a 50% retrace of the macro move down. Okay, so it moved from here all the way down to here. That's your T post that happens here, and then the midline of that is your Model T. And as you see, this stock jumped back up and it flashed above the Model T. And Model T is only for this part of the trade, because everything after that becomes much more convoluted. You're going to have to determine, is this something that is going to have follow through now that it's recovered, and this was a shake in a macro move that's occurring, and this is just a momentary lapse, or is this something that is going to continue? So this right here flashed above, and then it immediately dropped back and retest and hit a new low, which is not unusual, before it came back up. Now, in this case, this particular stock continued up. This was SPY. So as we know, this continued up. This is at 366 and change. So SPY, once this broke back up above that, then you not only had this pattern to show you Model T, but that generally becomes a resistance point and you see it right here. It became a resistance point. But as soon as that broke upward again, and you have now a cup also to look at, right? You got a cup, you got a handle. As soon as that broke back up above and started running, you go with it. You can go with it. Your odds are very, very high that you're going to now have a breakout from this retraction move that's going to continue. So Model T is very, very important in the scheme of how we trade. This is MG&I, okay? And what you'll see here is I had someone, I don't know, you're in the seminar. One of you are in the seminar, sent me a message and said you had sold out, and or you still had some MG&I left. What should you do? And you emailed me. I think it was about right here is when you emailed me. And I said, well, you're going to get a Model T move, number one. So if you're wanting to sell, you're going to get a midline move back up here to this 26 area is where Model T, again, you take the apex, you take the low, your midline is right here, and look at this. Take a look at that. Is that just not amazing? And this happens time and time and time again. And by the way, it does this not only on your daily inter-minute charts, but it also does this on your daily charts. So I kind of look at charting as, you know, if I'm looking at a minute chart, things happen fast, right? Things are happening fast. A lot of traders like 5-minute charts. I like 1-minute charts because I've learned to see. I see what's going on and I know what the market makers are thinking, and that goes into, you know, my decision process. But it's going very, very fast, and it's like getting that sip of water from a fire hydrant. So if you look at your daily charts, that's more softballs being tossed at you. And you can look at those daily charts, and once you spot a Model T occurring, you can trade that. And then you just need to get progressively, it's like your eyes adapting to a baseball player, you know, gets 50-mile-an-hour pitches, 70-mile-an-hour pitches. Next thing you know, they're throwing it 90 at you, and you've got to get wired in to be able to spot how that pitcher's releasing the ball and the spin on the ball, all of that other stuff that goes into being able to hit a 90-mile-an-hour fastball, along with your reflexes and ability, you know, talent to spot all that and to perform. Same thing. So you'll get faster and better at being able to spot these things. But start with your daily charts and start perusing stocks that you're in right now and say, do I have a daily, do I look at your, there we go. Do I have holdings right now? Go in and say, have any of these created this first portion of a Model T? And if it has, then start charting what that Model T, pick your top, pick your bottom, give us a Model T. If you take yesterday in the SPY and you say, what if the bottom hadn't fallen out and we rally today, are we going to reach Model T? Well, yeah, we would reach Model T, and we did, and we went well beyond it, and then we sank back down. But we did get there, and that's the key. When you saw the reversal happening, and I'm going to be sharing that with you of what happened today here on these slides, then that's what you are able to trade. And so it hit up here, and he was able to take his actions that he wanted to take, and it was successful. Here's Model T on a 1 minute of SPY. So you had 384.90 at the top right here. You have 383, and what you look at is you look at this right here from the genesis of the first upward move. So it would be this one right here, and then the tallest spike that you have, that number, you add those together, divide by 2, and that becomes your Model T. And so as soon as this came back down, okay, to into here, you're starting to think Model T. You're starting to think this thing is going to, after this big move, it's going to digest it, and that's what's happening and why these things are created. They're going to digest that move before it would do anything, and that's what happens. It digested down to Model T, and in this instance, it continued on downward on the day, by the way. And this was after hours that set up the drop-off. Okay, so here is one that we traded very successfully, both in shares and in options, and that is PLTR. And you all recall that I think I may have posted this chart. If I didn't post it on the forum, I did on Twitter, and I think it made its way over. But here's what you're doing is you had this long drop down into a bottom. And so I spotted this as a pivot point that I wanted to enter. And I started telling people that this is where I decided I'm going to buy shares, and I'm going to add to options. I had already added options here. When I saw this occurring, which is this move right here into the drop, major volume. And when that major volume could not send it any lower, I waited until about right here on the recovery to enter the next set of options and shares. So I was part of the buying that's going on to send it back up. So you're looking at this, and I wish I need to pull up this full chart because I have it on another chart. I'll show you a dynamic that you want to look for. But if you notice this right here, accelerating downward, it had been trending slowly downward all day. And that you that were in any options before this occurred painfully are aware of that at that moment, because you're questioning, should I still be in these options? Are they going to go, or what's going to happen? Well, we're just simply waiting because I'm confident in the move. It's going to happen. But this is post Kathy news, by the way, with ARK having bought in. And like I said, I think she actually hurt us more than helped us because it created a situation to where a lot of people, day traders, jumped in on the stock, and the market institution said, well, no, we're going to kill that before we send it higher, and they will do that. So a lot of times I hear people say, well, how come it sells off when the news was so good? Well, if it's a stock that institutions are big on and they want a large position in, they will kill a rally very, very quickly. And so that's what was going on. And this was like, I think 2 days after Kathy's announcement that she made the announcement on this stock. And it had been just drifting down day over day from, I think, 27.72 is where it was. And now here we are at 25.55. And it accelerated then. It was a slow grind. And then all of a sudden it accelerated. And what that is when there are no current buyers in there to continue just absorbing these losses, it'll accelerate. And when you see that acceleration on a stock, 9 times out of 10, that's when you want to be looking at it to enter. Because this acceleration curve, as long as you're on the macro, we were still above the 8, we were still above the 21. As long as we're still above those 2 variables and this is going on, you want to pay attention to that and be watching for the bottom. So I tweeted this, and I only sent this part of I did 2 slides on it. I did the slide that was right after the V right here. And then this is one that I wanted to show something else. And that is, if you take the top, when it pivot paused, okay, from the bottom to the top, 25.13 to 25.68, guess what? It came right back down to Model T, okay, $25.40 right here. Here's $25.40. It flashed right below that, and then it reversed right back up, which again, by the way, is a confirmation of this move. So you'll see this happen many, many times, both intraday as well as on a daily chart. And I've got an example of both, but you're seeing it here. And this is why I've told people, if you didn't get a chance to buy there, here's your opportunity to buy here, because this is a late target entry on the pullback. And this is a natural phenomenon that happens after a stock has bottomed, because it's a natural shake that occurs, and it encompasses Model T so many times. And so then it came back down, and you'll see that now Model T, it flashed below. Well, now that number has become support, and it flashed down right here. It could not make it. It couldn't reach it. And then we started upward, and the rest is history. Okay. So spotting these in this volume that you see coming, you see this massive volume, and the fact that the volume that is occurring creates these you see these sticks here, that tells you that even though there's this massive volume selling, there's people buying. Institutions are buying it because individuals aren't making these type of sticks below these big red candles. That is massive accumulation occurring that creates these sticks below. And so when that happened and it reversed here, that was my first indication that we're onto something. And if you notice, we had a reversal right here with no volume. Okay, there was no volume there. But then when this occurred, and this is a key strategy, I want you to visualize this, and I've got it on a bigger slide in a minute, but you see this just curved down hard into this major volume. Why weren't they selling major volume up here? Well, because they're trying to continue this pattern, but there's big institutional buyers sitting there. So you're thinking you're going to break it through, and those institutional buyers are saying you shall not pass. And so that creates the double sticks right here, this stick right here, this one here, into a reversal. It then fell back down, not as high volume, and then you had it drop to here again with major volume, and it couldn't go any further. No, it could not fall further. And here came the green candles, and the green candles of love are what you look for. And when that thing V'd and broke this right here, I knew we were in business. And when it broke this, I was 100% sure that we had reversed as a stock. And so I didn't care about anything that happened here personally, other than give people an opportunity that wanted to. It was a great opening to get in. So be very aware of this pattern at the ends of major down periods, trending of a stock. It'll accelerate into a bottom because it cuts all the stop loss people. It encapsulates them. That adds to part of that volume. And then you'll see it end up in these type of sticks, pinpoints that reverse it. Okay, so here's just another example. There's a breakout right here. It ended up gapping, coming back down, and then it topped out right here. And this is a daily chart. So this is net on the daily. You guys remember, we entered this trade because of this. Okay, so I want you to pay attention to what you're seeing here. You had a Model T occur. You had the start of it. I wish I had been able to buy it here, and I didn't, but it was here, topped out, and then you had the downtrend. So now you're on Model T watch, right? So you're on Model T watch, and this is happening over a period of days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 trading days to reach Model T. So again, this is why I want you to first start with these strategies on daily charts until you get the hang of it, until you're able to readily spot these things occurring. Then you can move on to your trading charts for a more precise entry. So I'm sitting here watching this occur. I had drawn this chart myself already before we got to it, because I already was waiting for Model T to come. And by the way, I also noticed something I want you to be very aware of, and that is that the Model T point right here happens to be where? Right here on this 50-day moving average. So we're down below the 8 and the 21. So that's kind of a danger zone, right? If you're getting down to that 50-day moving average, and if it breaks through there, then that can be trouble. But in this case, we pivoted right here this day. You can see the pivot occurred, and the line comes below the 50. And that's that tricksy move that I'm always telling you guys about. That's the trick, and I've got that on a slide coming up, but that's a tricksy move right there that's occurring, okay? And it starts by showing it flash below the 50, and I guarantee you there were a ton of traders that said it's below the 50, let's bail, because this thing's gonna fall off the cliff. But then it reversed, and this is where we made our entry into the call options. So if you go back to the post, you'll see that on that date is when I posted to enter the net calls, okay? And we entered, was it the 80 calls or the 85? I don't remember. I think it was the 80s off of this. Yeah, it was the 80 calls down here at 70, below 73 at the time. But this is a 7309 when I took this picture, because this is after the fact, and it hit this Model T again. Let's see, what is the form? Oh, I'll send you a private note on that later, okay? But I do post these on Twitter as well. But we ran this trade up, and it went into the money, and we all made a killing off of it, and we got out. And then what happens is another thing that you want to be mindful of, and that is it double topped. It spiked up here, and here was your top. It spiked up and immediately reversed down. That's not good. You don't want to be in a stock that double tops and flashes down, leaving a peg up there. You want to be very cautious when you see that. And even today on the intraday, I was talking about posting on Twitter and everywhere that the market needs to break through that 380 level, because right now it's a double top there, and that's always concerning, especially at a key number like that 380. It did break through, which told you that there's going to be continuation because it didn't flash and drop. It just moved, powered right on through, and we were good to go. But you can see this double top. That's a whole nother pattern that you would want to learn and be mindful of when you're trading. And certainly if you had any legacy options that you were like, well, I'm going to be greedy, then that would be the time to exit them if you hadn't already. Okay. Okay, so here is net. This was the 1 minute chart on that Trixie move. So I showed you the daily. Here's what it looked like that I'm staring at. Okay, and these lines here, by the way, on intraday, they're not the same, obviously, as a daily chart. So you can kind of ignore those in terms of your intraday trade, other than when they get tight. That generally means that there's right here, you see how all the lines are tight. That means that there's going to be a break one way or another that comes from that. But I spotted this after the open. I was watching it, and take a look at this. I want you to pay attention. It had been downtrending, right? I showed you that. Okay, on the daily, it had been downtrending, right? But let's take a look. What did it do? You see that? Same as the chart I showed you a minute ago for what stock? PLTR. Instead of just this, taking your money, bleeding you dry, it goes whoosh down, volume picks up, it bounces, it drops back, and here's this huge volume spike that it can't break. It could not break it and go further. Okay, I didn't enter. I still didn't enter. I had a mind of entering, especially then if you're on a 5 minute chart, you can't see this, can you? You see maybe that it's bottom, but you don't see this action that's going on of it bouncing upward is clear as on a 1 minute chart. And you certainly miss this, and that is the Trixie move. I'm sitting here looking at this because I'm targeting net. It's one of my stocks that I was targeting for reversal because it was coming into the 50-day moving average. So in terms of, well, how do you find your stocks? I would like to trade the same 10 if I could all the time, but I find a lot of different stocks, as you guys know, that have setups that are good. And this is the setup. This is one of my favorite setups. I want you to learn this setup. This failure of dropping down that occurs after a trend into it, and then this drop is when you need to be looking for a reversal. Now, is it a macro reversal that's going to send the stock just flying up? Well, I don't know that every single time, but when I include a 50-day moving average as a pivot point, then I start getting pretty confident that I've reached a pivot point that is going to be a macro event. And so when this Trixie move hit, and I love calling it that because it's so stupid, none of you will ever forget it, and you can spot it yourself, and that is the institutions are sitting here just buying. Look at this. They're just buying, and then all of a sudden they just turn off. They turn off the buys for a second so that the next sales that come send it below and let it fail, because the day traders, they get scared out. Most of them will get frightened out of that. And so that's the pivot. When it comes back, that's when I get confident and I start buying. Okay, and we posted this immediately to start buying net, and we made a bunch of money on net because the first parabola hit, and guess what? Here we came back down, Model T'd, right? It flashed below Model T right here, but look, there's no volume. Okay, there's no volume, but it reversed back again, and then here came a big sell. Couldn't send it down further. It immediately pivoted, and we were off. We were off. I was 100% convinced then of this. I'm sorry, this is going to happen. Okay, that this was going to happen. So there's that Trixie move right there below the 50 that occurred, and then we were in, and yeah, did we have to wait a whole day of sitting there and that stock didn't do hardly anything the rest of the day? Yeah, that's tough, right? But we were in, and the chart ended up confirming itself the next day. We don't have enough time to be going through all of these, so I'm going to go on. Okay, so there's net. There was our move in, and then here it popped and broke through and stayed below for a while. SDC, there's the pivot point. I should have had a larger slide of this. I apologize, because what happened is the same thing. It came in and it dropped hard into here, and then it had one final drop and had this pivot pin, and this pivot pin was on the 21-day moving average. It encompassed the 21-day moving average and then pivoted. And that's when we went into SDC the first time, and it ended up going up above 15, and we made 15.50 to 16, and we made a lot of money. So there it is again. So we caught the pivot, we entered, and it went all the way up to, what is that? Well, that was the first one. I'm sorry. That's at 9. This was the second one that moved up, and we've traded SDC successfully 3 times now off of these pivots. Okay, same pivot. So here's the day Trixie moved back up that I was spotting and waiting for, and off we go. Okay, here it is again, and this was the last time that we did. So 3 times we've traded SDC successfully, and I saw that it was having a hard day today after we've exited. Remember, I exited 2 days ago ahead of the fall off, and posted, tweeted that I'm out. I'm 100% out. I took the quick dollars on it, and am done with it. Here is skills where we traded it, and again, note this. Here's the 1-minute chart, and boy, it just went off a cliff, but I don't see any volume. Okay, so you're sitting here and you're saying skills is approaching its 21-day moving average, and it is. I don't have that slide, but that's what was happening, is it was approaching its 21-day moving average, and boy, it just fell off a cliff. It rolled, and then it really fell down, and here came the volume. Okay, volume plus reversal. You got to have them both. Okay, I don't want a reversal that doesn't have volume, because I can't have confidence in that there are millions and millions of dollars behind it from institutions. I want millions of dollars behind a reversal move so that I'm confident. Okay, so if I'm going to put a bunch of money into a stock or an option, I want the support of people knowing that those people just paid a bunch of money for that stock. Okay, 125,000 shares times $24. They're putting a lot of money in right there. Okay. And it's way above the average that you see during the day. Well, there was your reversal move. So this is where we entered the skills trade, if you recall. This is why. This is the day. This is where it happened, that we made good money off of it. This is why. Okay. So it had this first initial pop. Okay. It did a Model T. If I use slideshow version. Thank you. Let's do it.
Yeah.
Thank you.
This guy's teaching.
How do I get rid of this, Jeff? This over here.
Do it. This guy's made me a lot of money. This guy's amazing.
Can they see this too, though? Or see on my screen?
Yeah.
I'd like this to be the whole screen. How can I do that?
You need to get out
Come on.
of displays.
Beautiful. Thank you, sir. That's why he's my COO. All right. Do what? Yeah, if you have a message like that, that was very helpful, by the way. Thank you. Okay, so here was skills, and we're in the stock. So I watched it the rest of the day just to monitor and make sure what we see here. Okay, high confidence of a reversal. myself.
Yeah, sorry about that.
No, that was my COO that muted me. Sorry about that. Okay, so this saucer shape that you see here, very, very good to see after you're entered off of a large pivot move. So again, I want to be repetitive. It's just going like this, tracking down, tracking down. It accelerates down, and I love seeing this acceleration on the minute chart when I am looking to enter. I want to have my 21-day moving average, my 50-day moving average. I want to know what those numbers are already in my stocks that I'm watching. So those are already charted, and I'm looking at them. And this happened across the 21-day moving average right here. And it flashed below it, and then it immediately reversed. Exactly what you want to see coming off of a major support level of a 21-day moving average, okay? So this saucer move here, this shallow saucer move, very, very bullish coming off of this, okay? So steep decline, massive volume, pivot pin, okay, with green volume coming upward. Don't care about this. I don't care if it came and retested. That's okay, okay? This was the move that you were waiting for. And as long as volume doesn't come in here that matches or exceeds that, sending it downward, you stay with the trade, okay? You stay with that trade. We already saw this. This is Uber. I'm sorry, we didn't see this. This is where we entered the Uber trade, if you recall, okay? What are we seeing? Same pattern, okay? 21-day moving average. I had it charted. I should have put the 21-day on all of these. I apologize. I'll do that for the advanced seminar, okay? That's free for everyone that I'm going to be doing, okay? But here it is again. Look, I mean, just we're coming down, and then we accelerate, accelerate into here. Volume is picking up, but it can't go further, okay? And just like PLTR, it then shoots down one more time, and you have this volume. I had already bought, okay? I had already told the forum and Twitter to buy. This is where I was saying I'm buying. So if you're mirroring, this is where I'm in. And then when this happened, I tweeted I'm adding here, okay? Because I saw the flash below the 21, and this right here accelerated again. If this had just slowly grinded into it, I would have been concerned, okay? But the fact that it flashed into it was telling me they are clearing out stop losses and people in there. So when that reversed and then crossed over again right here, as soon as that was crossed over, I'm up to about 80% conviction. When this got broken right here, okay, you see this right here, the last top that occurred that happens to mirror here. So what do we have? I mean, you guys should know this one, right? You have a head right here. You've got a left shoulder right there. You've got the right shoulder right there. And then it pulls back a little, and then it broke above, and off you go. Okay. And this thing took off for us. And again, we made really good money on it. But that's what you're looking for. 21-day moving average. Here's a pivot right here that was above the 21-day moving average. I didn't trade it. Okay. I wanted to see this stock either make it to here, or if maybe later I would have thought about coming in to this trade if it had reversed on upward, but it didn't. So I'm sitting here waiting for that 21-day moving average, and we got it. Okay. Here's a double bottom off of Uber that occurred. Well, that's after the fact. I'm going to skip that one. Okay, y'all remember I posted this and tweeted it, the ahum on WWR. And what you have here is this flag pattern that's a rescinding, it's a pullback that's happened after the initial explosion move here. Okay, this is the first, we were not in this trade. We started accumulating, I can't remember, somewhere in here, and then we got lucky. I'll say it. We got lucky, and the thing bounced for us to be able to both sell some shares or sell some covered calls. And then it went on up here above 7, and I thought for a moment that did I just now strike gold, and I'm not going to be able to accumulate this. I'm just going to have to enjoy a ride. Well, then this right here hit, and this stair step action, as you see, is institutions. What causes that is institutions that are wanting to mass accumulate are just turning off very, very controlled bid. They're turning it off, and they're letting these lower, you see there's not hardly any volume, okay? Not a lot of volume there. And all that has to happen is the big institutions are just sitting back and they turn it off until it hits a certain point in a day, and then they'll support it. And then they'll do it the next day, and it'll be lower and lower, but it's a very controlled pattern that's created that's very unusual, by the way, right? You don't see this pattern a whole bunch, although it happened today on SPY. I'll show you here. But I went because it broke back above the 3-day. 1, 2, 3. Here's the 3-day high. It broke above that, and I didn't care if it came back down because it broke. That's the signal. Okay, that's the signal. And what you do is you trade off of the signal. And so you're starting, I'm like, I'm back, I'm mass accumulating like crazy. I'm selling puts. I'm going nuts on this thing because of this pattern. And of course, we know that from then on, it just stayed right in here. That was right here about mid 450 or so. And I don't think it ever got below the 450 mark again. But we just mass accumulated, and that's why it became a mass accumulation stock here, confirmed here. The institutions weren't ready. They are not ready for this to go. And as I said, they had a lot of time. Okay, this doesn't, their production facility doesn't come online until 2022. There's all kinds of reasons why I don't see this stock really, although it got played by our friends out there this week. I don't see that happening. But here's that pattern, and you'll notice, you know, that these are days, right? But all of us were doing crazy things all through this period. We were capitalizing on the pops above 6. We were capitalizing on the drops below 5 to accumulate shares. We would sell a few anytime it got to 550. We would do covered calls, all of those type of things. Well, then this occurred. And so this was like the heavens opened up, and it allows all of us to get net free is what this move allowed us to do. Okay, so you almost had a natural, if you bought below 5, you almost had a natural net free occur here. But if it wasn't natural, then you should have been selling covered calls. And I tweeted and posted that, you know, here's an opportunity for you to sell calls and be net free on whatever percentage shares that you want. You can do that up here. And if you did that, and this stock has dropped, I don't know where it ended today, but it dropped back, you know, it's run its course for now, and it's going to pull back and consolidate. I don't know if it'll make it back to 5, or if this will become kind of a benchmark here around this $6 level. That's my first inclination. You see all this happened. It had a lot of support as this move was genesis of this move. That's my first inclination, and it happens to be in a Model T area up here, to where a Model T can occur off this move to here. A Model T can occur and then flashes below that into this support level. Okay, so I don't know short term what WWR is going to do. I think it'll consolidate its move because, I mean, frankly, let's think about it. $5 to $9 is almost 100%. So of course there should be a period unless there's some macro event that occurs. But this all started from here, spotting this, okay? Spotting this, and if you notice, this is why you have to be watching. This is a daily chart, and you got to look at it daily. That doesn't look quite the same here, does it? Doesn't look quite the same. Still looks, you know, you can still see this, but it doesn't look like, if I'm watching this stock chart every day, much more defined, okay? And so you got to look at those charts daily of the ones that you're interested in. Look at them daily. And if you're doing a minute chart and you're going on the intraday, guess what? Same thing. That's not going to look the same on a minute chart if it happened during a minute during the day, the longer that chart develops throughout the day. But it's important for that period of time, okay, for making decisions. Okay, so here's SPY. Now this happened today. This was pre-market, is back to our left, was way down at 370, I think. And then it came back up all the way here into the open. Right here's the opening, right? which it dropped down and pivoted immediately. Had this pivot here. So the sellers were trying to regain some momentum and control. Didn't happen, right? And so here's this pivot. And again, Model T, okay, from here to here, not much of one, but it is over $1, so it's important. So here's that Model T, it couldn't reach it, pivot, and it pivots again, and that started the bigger run, okay? So you already had a pretty good run here on a slow trend, but then it exploded upwards, and then here is that same stair step down. And all that is these big dollar people are just sitting back. And you notice here, it gets to a U shape. That happens a lot on this chart, by the way. On this stair step, this happens a lot because the bears aren't sure that this is a reversal downward, and the bulls are just walking it down. And so the bears stop selling. They stop selling, okay? They stop shorting it. They're not sure. And they think, well, it's continuing down, so they'll start picking back up. And man, the institutions are just loving it. They're just sitting back, absorbing the shares. And then you see this pivot right here that occurred. Very similar. This is on a 1-minute chart of what we showed you with WRR on a daily chart. Exactly the same. It pops up, right, above, in this instance, a 2-minute. It pops up above, it sinks down. We don't care. This is the signal. It pops down. And what I did is, here it is, right here. Did I go 2 slides too many? No, here it is. So does it look the same to you now as it did here? I don't know, maybe it does. And I'm gonna be sending you all of these slides. But here it is, here's that move, okay? And so here's the big move, okay? There is Model T being achieved, okay? It came back down, and just like, what was the stock that I showed you that I said I didn't care if it came back down? PLTR. Okay, we had entered, it came back down, it couldn't violate here, okay, it dropped below Model T, and look at these huge sells. You see these huge candles of red, meaning a lot of sells, and yet it can't drop. Well, what's going on? Why can't it drop? Because the institutions are buying, knowing that this is going to happen. They have a day of trading that they're wanting to peel money. So they're absorbing all these huge buys. That's a huge indicator for you that what you saw here and this pattern that you trade is correct. Okay, that's great confirmation. It can't break down. They tried 2 minutes worth of selling and couldn't do it. So what happens? A mini version of this. The institutions just stop buying, no volume, okay? They just stop buying for a couple of minutes just to get, you know, some people shaken out, and then up we go exploding, okay? So we exploded upwards, and you know the rest until the apogee, the top of the day occurred. It just kept on rolling. And so that's the importance of this pattern. It was great for WWR. It was great for intraday, being able to enter into a trade, to know that, look, if I'm short something, or if I want to buy puts on SPY, I don't want to do it right now. I know it's going to go higher based on this pattern, okay? That's what it's telling me, so I'm going to let it develop until it tells me differently. And it confirmed, and up we went, okay? Okay, so here's mid-range of that. So this is not quite as mature as this one. So you can see again up, here's Model T. So I charted Model T, boom, it hit it exactly. It comes up, and then that secondary, okay, support found right here, up we go, and then off we go. That's what it looks like. That's a great, great pattern. It doesn't happen a lot, and I was so pleased that it happened on SPY while I was sitting there watching. I happen to have SPY open, and I happen to be watching it for obvious reasons. And when this happened, I was just like, unbelievable. I get a wedge pattern that is a square wedge pattern to show in tandem with the WWR chart. Fantastic. NEO, we're not going to waste time. Everyone knows about NEO, right? Here is a goalpost, okay, on a daily. This is big C, okay? So on big C, It had been trading down here below 65, and you guys know the story on that, that I wanted to be in it. So I was selling puts, naked puts on it. I had accumulated a position in it. It made this initial run here, but hit resistance, and you can see this stair-step resistance that's occurring. Okay, these are things that you should be charting. You can see this, right? Just pull up your chart and start looking for where's the resistance. Did it match that? Would I want to be peeling off if I bought shares here and I reach a completion of a cup, and that's what that is, not a classic, is classic, but that's what it is. Should I be selling some shares? Yeah, you should be selling some shares, or at least some covered calls on that at this resistance. And then it fell back down and it retested and actually dropped a little bit below, but look at this volume. Okay, so we had our first, and if I bring up the intraday on that, guess what? You're going to see that same pattern that I talk about of accelerated down move that then pivoted and reversed. And so the next day, it still stayed low, but I'd already committed. I bought more shares. I sold more naked puts. I even bought some calls on that, and it came up again. And here is your next one. Okay. It didn't even quite complete. It got close, but it didn't quite complete. But you know what this is? Okay, that's 62.20, and that is nearly $85, folks. Can you make some money with these patterns? Okay, yeah, you can make some money with these patterns. So you're selling, you're doing covered calls again, and then off it came back again. And this is into January now. And this was the pivot then. Notice it's almost like a goalpost move, isn't it? Okay, kind of like a goalpost move. And it reversed from this down of holding it down and these patterns coming, and this volume hit and it broke through this. So the cup completed. I still sold some shares because I just bought some more. Okay. But it broke through and I had calls on it, and the calls took off, and this thing shot up, and I don't know if you guys saw it, it hit over $93. A couple of, either yesterday or today, I can't remember now, but it hit over $90. So talking about almost being net free on a stock. But Big C is one that I love long term. So if we get a macro pullback and you see it here, I would say anywhere starting below $80, start accumulating some shares and start doing some of the practices again. Here's Big C. Here is that reversal happening during the day, that the big arrow. Here it is on a 5-minute chart. So I wanted to show you, here's what it looks on a 5-minute chart. So yeah, 5 minutes beneficial because you see that every 5 minutes is going. It was 20 minutes of trying to break down through this that it couldn't do it. 20 minutes, okay? And it had a huge candle here, couldn't break it down. Huge sell. So the bears were trying for all they were worth to break this thing down, and it didn't happen, okay? Here's what it looked like on a minute chart, okay? Now, you wouldn't have seen this on a minute chart. You would have seen that big red candle. But guess what? There's a huge institutional buy. The volume accelerated into it. Okay, look at this volume acceleration, and then it dropped back down. And where are the bears? Why didn't they return? Okay, where are they? All that selling is gone, and now it's all green, mostly green candles. Here they tried real hard, and look what happened. It couldn't break down. There's your confirmation on a 1-minute chart of why I think 1 minutes are more valuable than 5-minute charts, because I see this and I say big sell came in trying to break that thing down. Institutions had already set the bottom. They said that's it. And the pivot had occurred. And so up we went, and this started the run on Big C. Guild, you guys know, I said, let's start the year off with a win. I'll tell you that I got a little nervous about it, having so many people in on this, but we bought options about right here at the Model T of this move. Okay, from here to the Model T is somewhere in here. We bought our first round of calls, and we paid, into I think $1.15 even on those, maybe $1.20, $1.25. I can't remember. And then it proceeded to do this, which I both liked, but I didn't like because I knew we were in this, right? But it double bottomed and it hung there, and this is a daily chart, okay? So it hung there for 2 days after it had sat right here. It went into some major volume that it couldn't drop. Well, I was waiting to see if that double bottom occurred because the institutions just simply stopped buying. And because they were buying here in big volume, they were just absorbing all of the sales, but then they took their foot off the gas to let it come down and let it shake people out, and it hit this double bottom, and then it started to bounce. And boy, I think all of us knew when it started to bounce that we had caught that very nicely. And then it jumped up initially up here. Let's move on. We're going to run out of time. I got to get to options here. Here's the dreaded H, okay? So you had this SPY, it broke, okay? It had the trend going, trend breaks below, okay? The lowest level that we have on the chart, it breaks it and it accelerates downwards. It goes up and bounces, and then it falls immediately back down. And as soon as it breaks, okay, as soon as it breaks this, you've got yourself a dreaded H. That's a dreaded H pattern. That is a very bearish pattern. You hate to see it if you're long. You want to act on it if you're long. You don't want to be long if you see them in succession, okay? And we did. We saw them start hitting in succession, and even this big volume brought it up. It went right back down, okay? That's advanced. I'm going to get to that on the advanced seminar. Let's move on. I want to get to okay, there's the net pivot. I think we already covered net. Okay, here's one that's fun is Microsoft. Take a look at Microsoft, and you'll recall I kept looking for Microsoft to hit below 195, and it just never would. But it had what I call an arrow formation, and that is you get the line that happens to be, by the way, Model T of the initial move here off the bottom to the top. Here's Model T, and then what's going to happen is there's going to be a period of sideways move. I don't know that it's going to be a period of sideways move, but what I do is I will buy anytime I get down here again. I'll buy calls. I'm not going to buy the stock again. I'm going to buy stock right now unless I wanted it for a super long, and I'm already net free on Microsoft in an account. Why would I buy shares here? So, but I bought calls, okay, and I buy my calls in the midline somewhere in here. So in terms of people asking, well, how do you pick your prices? Well, if I'm going to enter here below 200 on Microsoft, a call option, I'm going to look and say, well, what is my midline? And it's somewhere around 214, and my call is going to be 214. Okay, so I bought 214 call options. When I got anywhere close to that, I'm already over 100% because of the move that's happened. But then I start counting on some type of a move back towards the top. And you'll note that every successive move generally becomes less than the one before. And we had an anomaly here where it wasn't. It actually jumped way above, but immediately reversed and fell back down, which told me that we are going to go through Model T again. It's going to come back to retrace all the way back, and it did, okay? But these are the trades. You could trade it right here, after this first one, okay? I don't mess so much with puts in a bull market, even though we weren't sure when a correction might come. I will only trade these, okay? So I got 2 trades out of it, out of Microsoft, and then it dropped down and it never came back again. And you guys know it took off up to 240 something after that. But I love these type of an arrow trade. And you'll see I call it an arrow because it gets more condensed and more condensed as the time goes, and it forms that arrow to a point where you see it just getting so tight here. And all of the Bollinger Bands, the people that use Bollinger Bands and everything else, those bands are getting real tight. So a bigger move is about to happen, and you know it because of that too. Which way is it going to break? So very good trade. That once you spot these sideways movements, I think we're going to enter a period of time here where we're going to have sideways opportunities, and we'll be using a lot of options off these bases based on this type of a pattern that I think we're going to be seeing. Okay, you guys remember our angst on AMD. First of all, it was above 92, and the day before, it kept hitting, dropping to 92, and it kept bouncing off 92, and it would run up to 95, one time 96. I think some of you were smarter than me because you sold some of those bounces. I was waiting for the move to 100, and I didn't. And lo and behold, it broke down below 92, and I stopped out. And it dropped all the way down into the 80s. It came back, and then what do we always say? That support becomes resistance. Support becomes resistance, and once resistance is broken, resistance becomes support. So it works both ways. So 92, we had pegged a day before as being support. It broke, so now it becomes resistance, and sure enough, as this stock moved all the way back up, here it is bouncing off of 92 because 92 is the resistance point. So you're sitting here saying, well, I want to enter a trade, but I'm not going to enter it if it can't blow through that 92. Well, it did, okay? And here is that blow. It blew up above 92. What do we count on? Am I going to chase it? No, I'm going to wait for Model T. Here comes Model T, okay? I buy. So I bought some calls into that. It dropped back down below my Model T. Again, does that happen? It's happened on what? 3, 4 of the charts I've shown you after I've entered a trade. And I think that's when I get all of the messages of what was me and everything else. And is this dog ever going to do anything, right? So we all know it, and I feel that pain. But then it reversed and it started up and it confirmed, okay? So this time I made my losses back and made good money, way more than I had lost off the stop loss. So that's the importance of recognizing that resistance support line, though, is because it allowed us to know that, and again, here's 92, here it is, see it, 92, guess what? It becomes support because it got broken. See how that works? It went from being support to short-term resistance for a while here, and this went all the way back even further, but it kept bouncing off that 92, it pulled back and then exploded up through it. So there was your first signal that now we're in business. You wait for the Model T pullback, that's your entry, and then as long as you don't fall back below the 92 with volume, okay, there's no volume here on this retest. And then it took off. Look at this build that happened. You talking about knowing that you were in good shape. All these green candles just sent that thing just up, squeeze, and that's a short squeeze starting right there. And then they just didn't let them do anything, and it kept on going. Okay. No time for that right now. Okay, so this is close to current, not quite, but close, and it's important. Okay, because you have obviously the break that occurred, the correction here that occurred back in September. It created a W. Okay, this pattern right here, this is on the dailies. This is a long-term developing pattern that's extremely bullish. Okay, the W, put that in your notes. The W stands for win. Okay, winning, winning, winning. The W stands for winning. Okay, you got a double bottom off of that. As soon as it breaks that top of this right here, you know that the odds are very, very high. Trend is continuing. Okay, so we continued trend. We hit new highs up to somewhere up in here. Okay, we had a day where it came down here and hit the 21-day moving average, and I was on alert, right? I had hedges. That's the day that I said I closed some hedges. Because they popped and I didn't know if it was going to continue. So I always do, as a matter of course, close some hedges when they rocket. I think they moved up $1.25. So if I'm sitting in those things at 350 and they go to 450, I'll take $1, okay, off of those as a measure. But I don't want to sell my hedges. I'm very reluctant, and I don't take a whole lot off because they're my insurance, and I don't want to cancel the insurance. Okay, I don't want to cancel it on my home. I don't want to cancel it on my car, and I certainly don't want to cancel it on the market, because this is what's going to happen, and this is eventually what did happen. It didn't it? Okay, it eventually did. After it broke up here, it eventually came down and did hit the 50-day moving average. Okay, so if it breaks and violates that, I mean, then it's your guess. Okay, your guess is as good as mine. Mancini's a brilliant trader. This is the 200-day moving average right here that's moving here. So that's a natural target that you would have. The first thing that you do, though, is you look back and you say, are there any gaps? Are there any gaps to fill? And there's not. There's not a single gap on SPY. And I wish there were, but there's not, because those become very Here's obviously a pivot, right? This could become support right here. That would be a natural one. This could become support right here. This did become support yesterday, okay? So that's what you're looking for, though, is once you violate a 21-day moving average, the red flags are waiting to see if you're going to fall to the 50, and then if you fall to the 50, the red flags are, am I going to lose it? So that doesn't mean you don't enter trades. So the 21-day is generally a very strong indicator. If you can get that indicator in, it's pretty strong to maintain a trend. Hey, here's SPY doing notice these, there are many versions of it, and they just kept doing it all the way up. Had this V in here, but these are bullish. These are very bullish, and as long as I'm seeing that on the daily pattern, I'm sticking with SPY. We were moving. This is all the way. This is sometime back. This isn't at 370, but these are telling me we're still in good shape. As soon as it breaks above, just like WWR, just like the intraday trade that I showed you, that this pattern comes. As soon as you break above, the signal's lit. And you should be in a stock. Chart these, chart them. They will make you money. This square box that you see here, it is bullish or bearish. It can be either one, whichever way it breaks out of it. This is kind of a mini Darvist box that happens on a daily. Whichever way that breaks, that's the direction you go with. Now here it is again. So you take a directional on the daily, and this is for trading purposes. You're counting on a break, push upward. So it's not like you're going to stay in SPY forever. You just want to get the money out of it, and it gave you money. That's a pretty darn big move off of Big C. That's Big C, I'm sorry. So that's a pretty good move off Big C, right? Same thing here. As soon as it broke up above, off we went. I shared you a daily on that. This was Clove, and I shared this. Here is a saucer that was being formed, and you see the selling drop off here, and you see that it had its big down day here that popped back. So you obviously got institutional buying. That's too much volume that's hitting a stock for it not to go up without it being institutions, folks. So when you have that kind of a move going on, that's institutions supporting, and they're doing it up here too. And here's this sideways, here's the box move that they're just taking their foot off the brake. They're in control. They're in complete control of this stock. Most people just can't see it. When you're seeing this move, you should start getting excited, because that's telling you they're just simply letting the foot off the gas to accumulate more shares. And then they said, that's it. We're not going to let it go anymore. So the bears, the volume just dropped off. They're like, uh-oh, I think we're in trouble. And then here comes the bull saying, yeah, you're in trouble, all right. And then, of course, Clove then finishes the cup, It finishes that cup and all the way up. So where is that cup? It's up here at 17, and we flashed. I didn't get it all. This was intraday when I was telling people that you can buy this, that if it breaks out of here, I put that on Twitter and in the forum. I said, if it breaks that was the same sideways channel. As soon as it broke upward, I said, you can go in for a ride and trade it that way. Okay, that's it on those. And again, I will send these to you. I'm going to write notes on them so that you have those. but I want you to send me some charts where you see those things. Okay, so that I can confirm that you're seeing. Don't do that. I don't want to leave the meeting. All right. So here we are on our screen. Okay, and if I go in, we faded here at the. Look at that. So here, what's happening here? Here's some volume. This is the 1 minute chart. We're seeing this in real time. So we just floated down, and now we're accelerating into a down. We've got a pivot that's occurred right here happening on the minute with increased volume. We'll come back to that and let's see what happens. Okay, isn't that interesting? Okay, options. I'm going to pull up the options for SPY. May take a minute to load. So first thing I've got here is, I don't know if you can, hopefully you all can see this. That's a Popeyes. Let's see, I got it on there. Yeah, I got it on there. That's a Popeyes coupon. Okay. It says that you can buy that 3-piece basket for $3.99 with this coupon. Okay. It's regularly $4.69 at Popeyes, but with this coupon, I've got the right to walk into a Popeyes and buy this for $3.99. Now, at the bottom down here, I don't know if I can get it close enough for you to see. Let's see. See that at the very bottom? It says expires. Okay, expires what? I gotta get my glasses off for that one. 2/28/21. So from now until February 28th, 2021, I have the ability to walk into any Popeyes and buy a 3-piece meal for 70 cents cheaper than the price on the current chart that they have up there. Same with an option of a stock. Okay, it's very, very similar, very, very same. They have expirations. The only difference is this number right here, the $3.99. If I paid someone for this coupon and I said, I'll give you 30 cents for that because then I can still save 30 cents on the stock, that 30 cents is going to deteriorate the closer I get to 2/28/21. Okay, it's not going to be as worth as much. Unlike this, it's still going to be worth full value of $3.99 all the way through 2/28/21. Okay, but the concept is very much the same, and that is that it's a coupon, an option to buy the meal for 60 cents off, 60 cents cheaper. Okay, so about this, when I'm talking options, options obviously will deteriorate over time. It's decay that happens because the closer that I get to expiration, if the stock is not moving into the direction of the option price, then it's going to decay in value because it's the odds of it being able to push. If I'm looking here, let's see, SPY is at right now. Where's my? Oh, this is the one I pulled up for. Okay, so SPY right now is trading at 376. So I can come here January 29th, which is tomorrow. Okay, tomorrow I could sit here and if I had bought a SPY put for $3.79, it would have cost me $2 or $2.64. Well, right now a $3.79 put is in the money by $2.35. Okay, so $2.35, but I only have a day, and if the stock bounces at all, this is going to deteriorate super quick, right? I don't have any time. If the market falls off the cliff tomorrow, well, then I just hit jackpot. I got lucky, okay, on that one. Or if my read tells me that I needed to be in a hedge, and I wouldn't have gone with something as expensive as $3.79. I would have looked at the closing price of the market. Let me take it down here. I would have looked at the closing price of the market. Okay, was somewhere. Okay, was it here? The 380 mark. Okay. No, it was right in here. So it was around 379. So if I was going to be looking at an option, let me get back to that screen. If I'm going to be looking at an option, then I would be looking somewhere down here at the 376 level. Okay, because again, what is the purpose of my option if I want an extra measure of hedge because the market was fading into the close, and I'm now concerned that the reversal that happened today is going to turn into a sell-off tomorrow, and I'm in some positions that are going to make me good money if the market does go forward, then I may take a risk here and buy a 376 put for $1.50 before, after the market closes. And again, it's drifted down. So it would have been cheaper than this because the market continued drifting down after the close. So if you had decided to enter a put option, you probably could have gotten this for about $1.30. Okay. And I would probably have targeted $1.50, which would have been probably this 377 would have been about $1.50 at the time. And it rose up to $1.82 at the 15-minute mark when it ended options. So options are simply a coupon, think of it that way, that guarantees me the right, if it's this 376 put, I have the right to sell SPY at $376. Okay, no matter what the price is below that, I have the right to sell it at $376. Okay, it cost me $1.50 for that right to do that. Okay, so if I'm wrong, I'm going to lose $1.50 or at least a big portion of that, because a one-day option versus coming out, let's do this. February 5th, a 376 option, look at that, $4.75. Why? Because you got 5 days, or actually more than that. You got a lot of time between now and then. If this market turns over and starts heading south, well, then this is going to be in the money immediately, okay, very quickly, and it's going to increase in value if that drop happens tomorrow, okay, or even Monday. But if we start going upwards, this is going to start deteriorating, but it will not deteriorate at the same rate as the January 29th. Someone want to, oh, I see, it's established.
That's yours.
That's me?
That's your application.
Oh, it's not go to meeting.
No.
No. Okay. So I want to take us here. Let's do this because this really will explain. Hey, AMC, boy, oh boy, what a ride. Okay. So we were sitting back, right, and surveying the landscape of the economy post-election. And one of the things that I asserted was that the Democrats, and I don't want to get political, but I asserted that the Democrats would reopen the economy immediately. I think most of you probably knew that. So what do you start doing? You start surveying the landscape and you start looking at stocks that have just been absolutely hammered because of this virus, okay? And it was above this. I mean, it just kept dropping. And then, so it dropped here, gap down, and it's just on a death period, okay? Well, we saw this. And so in the thought process of the economy opening up, it was just very simple common sense that people are going to go to the theaters again. So AMC might be a stock that we would want to be in. And so what we did is we posted on the forum, on the Twitter, that we're buying leaps, 2023 leaps for $1, I can't remember what they were, $1 and change at the time for 2 years to see AMC starts moving. Well, it started moving almost immediately after we had entered. And this was before all this started happening. Maybe they were already starting, I don't know, but it jumped immediately to $5. We were making, over 100%. I was able to sell 30% of my call options at that time. Let me pull up the options here. Okay. So 2023 leaps, and it's called a leap because it's a long time away. Let's just keep it easy. Leaps. Okay. Leap years. So I'm 2 years ahead here, and we bought 250. okay? And we bought them for $1 and change. Well, they closed at $6 and something 30 cents here, 6.75. There's a big spread because the market is very volatile. That stock is moving, as you know, if you watched it, it's moving like crazy. So there's going to be a big gap here between the buy and the sell of all of these, okay? As well, you know, here's the put side of the equation. A little tighter, if you notice. I find that a little interesting. I'll study that later. But anyway, here we are. So if you bought those leaps, now you're sitting at 630. Well, if you had taken that, let's go to that 250, and I'm going to take an 8-hour. Here they are at the open. Okay, they opened up on the day that it spiked. It spiked above $26 in the pre-market. Okay, it spiked above $26. If you don't have on your platforms, I'm telling everyone out there, if you do not have the ability to trade stocks between the hours of 3 a.m. and opening of market and between the end of market and 7 p.m. Central time, then you are severely handicapping yourself. And in this instance, you left tens of thousands, if not hundreds of thousands of dollars on the table. And here's why. You may say, well, Randy, I can't sell the options during the pre-markets. They're not tradable. And you're right, they are not tradable. You would be sitting there with that $2.50 coupon that's going to expire in 2 years. So you're not so much concerned about 2 years from now, because right now, today, it's trading at $26. And you can't wait for the market to open, because you can exercise, you can sell the call for $28, because there's a premium for 2 years worth of value that gets added on to whatever the stock's trading at. You pay value, you pay premium, and the premium increases for more time. Well, we're at the extreme of time, 2 years. And so those $26, if they had opened at 26, you probably would have been able to sell those for $30. Wouldn't have surprised me a bit if you couldn't have got $30 for those calls that were again cost you $1. But the stock is trading over $25. Well, what do? Because you can't wait, and you don't want to wait for the market to open. What you do is you have the right to buy the shares at $2.50. You've got the coupon. It doesn't expire for 2 years. So you go out and you short AMC at $25 or $26. You short equivalent amount of shares as to your calls. If you have 10 of the calls, that's 100 shares per call. Every call or put represents 100 of the underlying instrument volume, okay? So AMC, if you buy 10, you now control 1,000 shares of AMC for until 2023. You have the right to buy them at $2.50. You control that. That is your option to do with it at any time, anything you want. You can sell them, you can trade against them, and that's what we're talking about, is you're going to reach out in the pre-market and you're going to short AMC. Why? Because you shorted at $25, let's say, you are now negative the stock, okay, in terms of on the actual account. You are now negative the 100 shares or 500 or 1,000 shares of AMC. Well, guess what? When the market opens and those things are now at 17 or 18, you don't care, because you can simply call out your shares. You have the option to call them out at any time you want to for $2.50 and own those shares. Well, if you are negative 1,000 shares and you have a coupon for the right to buy 1,000 shares for $2.50, guess what? That negative 1,000 closes. It's off your screen now, but you closed it from a $25 entry of the short at $2.50. So $2.50 plus the dollar of premium that you paid for the call. So let's say $3.20 minus $25. That's how much you made. You made $22 a share because you had the ability to trade in the off hours that you otherwise never would have had an opportunity to do. That's why you get on platforms like Interactive Brokers, I don't care which one, that allows you to trade during the off hours. And you'll remember CIDM caught a lot of people. It opened in the after hours at 3 a.m. It opened at $1.34. It jumped to $1.40, I believe, somewhere in that range, fell back down, and until recently, it never had gotten back there until it fell all the way back down to 60 cents again, where we loaded back up. But we were selling, and we were already well above net free from our 60-cent previous buy, but it fell below $1 at the open. You would have missed it. Okay? You still would have been able to sell for a good gain, but you would have missed a huge opportunity. So I implore you, I'm begging you, that your first objective before you begin trading, if you're new and you've been having, frankly, success in other platforms, get on a platform that gives you full access to every tool available, because these things happen. And that SPY that I talk about, when I have the option, if I enter a put on SPY, and a put is exactly the same as a call, except it's giving you the right to sell it at that price, okay? So anytime I can walk in and say, you know, if they lower the price to 340 and I'm making money and I have a put option for 399, I'm like, you got to give me 399, and I get to pocket that 50 cents now. So that is a put option. It allows you to sell it at that share. You pay a premium for that. And so you obviously would love to be right on that premium, but if it's a hedge, not so much concerned. It's insurance. So if I wanted another layer of hedge, I didn't do it today because I had this being prepared for, but I probably would have had I not been doing this. I probably would have bought a cheap put on the market, because if the options, if the futures in the morning at 3 a.m., let's say that we are going to retest back down at the 371 mark, somewhere in that range, and I have a 376 put, so I have the right to sell at 376. Well, if the market opens at 371, I'm golden. The premium on that is going to be exploding, right? But what happens? How many of you guys were holding, you know, all your hedges of 335 puts out to March? Those went from 251. They topped at $7.25 yesterday. So they more than doubled, tripled, okay? So you got to take those profits on some of that, right? Not all of it, but that's why I like my hedge to grow and be big, because I like to be fluid and able to trade with those. So the put, if I wake up in the morning at 3 a.m. and I have a 376 put on SPY and it's trading at 371, I do the exact opposite of what I just explained for AMC. Instead of shorting, I go in and I buy a SPY position equivalent to at least half or the full, depending on my appetite or how much other hedge I have. I would probably buy full shares against it. So if I had 30 of them, I would buy 3,000 shares of SPY at 371. And what you've done is I have the right to sell it at 376. It cost me $1.50 for that put, okay? So 376 minus $1.50 is 374.50, okay? I buy at 371, that's my profit. The difference between 371 and 374.50, I've made now $45,000 on something that cost me what, 30 of them times $1.50, $4,500, okay? So that's why you do it, okay? That's why you do it. So, and I'm not advocating anyone take large option positions, especially if you're new. Start with 2. I do always like people to do 2, and the reason why is common sense. I want you to be able to sell one for 100% profit. So the trades that we're making, I'm targeting 100% profit minimum on my option trades. That's what we want. Do they all get there? No, but we've had a very good track record in a bull market of being able to have a very high success rate of 100% plus on options. And if you have two, then you can sell one and then get the knowledge of just what the apogee is on the gain. And I'll try as much as I can to give targets of where I think it'll be. Like Apple today, it sank. Obviously, we've got a lot of time. It's at 137. I think it's going to get to 150 because I do think that regardless of what happens tomorrow or even the next day, I think we're going to bounce and we're going to go higher. And so I think that Apple is going to pay. I think that option will pay us. So a lot of people say, well, should I double down? Should I buy more Apple if it opens up negative tomorrow? That's an individual's choice. And generally, when I do something like that, I'll be reading the market very closely. And if I decide to do that, generally those are trading. Okay, what I'm looking to do is I'm looking to buy them in order to sell them and make up the lost gap, okay, that my original options traded at. So we entered into these Apple calls today. Let's go to it and see the pain. Okay, so we entered 319, 150, okay, at 247, around 247. Well, look, they're at $1.84. Okay, the sky's falling, right? So, oh, here's my little free. I told people I threw 30 grand over into an account for this. Here it is. So I traded it up to 34,000 before, just getting ready for the seminar to show you guys some shares and everything. And I did buy some EGOC for you in there. So I'm bought some in this account. Okay. So these options here again, let me get back to them. February 19th, 150. So I have the right to buy Apple at $150 come February 19th. I'm counting on the stock to be approaching that 150 mark, obviously, before we get there, because let's look at 150s today. They're expiring tomorrow. Let's do that to give you guys an idea of how this works, how decay works. Here's options, and January 29th, 150s are 6 cents. So if we get to February 18th, and Apple is somewhere around the price that it's at right now, guess what? Those options are only going to be worth 6 cents. That's where stop losses come into play. If this market tanks, we're going to end up stopping on that trade at $1, and it's going to be a trade that is a loss trade. Okay, so I don't want to be in this trade to 6 cents. I don't want to ride this to zero. Okay, I want to preserve the capital. I want to give it enough time for the trade to work, but I don't want to risk 100% of my capital. So I'm going back to Apple. Let's go out to next Friday. You got to pay 70 cents if you think that you can get a move immediately, and that's 70 cents. Whereas I'm paying $1.80 right now. I paid $2.47 earlier. Okay, here's the 12th. $1.35. So you've got to give enough time for this daily noise that's occurring, okay? And that's what this is. This is daily noise. It's within this frame here. You had the stair step up, right? So you've just got a little parabola, and you've seen these on day charts that we were showing you intraday happening, right? And then it took off. Okay, that's what we're going to look for. And here we're still firmly above, okay, our 21-day moving average. We just crossed the 8-day, so it's something to pay attention to, but it's nothing compared to if we were to lose this, okay, the 50-day moving average. So we're fine on the trade, and you see here that these got real tight in the bands like we talk about. It gets real tight, and then it breaks one way or the other, and you want it to break that way. So right now the bands are a little apart, and you can see this one's starting to, they'll probably bend. This one's bending down. They'll come probably up again together, but you have this selling volume that's been happening in there. And so that's 4 days of selling. Okay, here's 4 days of selling, and then you got to stop there. I watch this a little bit, but that's not my key. Okay, my key is going to be the macro chart in the 8 and 21-day moving average. That's what I'm paying attention to. Okay, so we entered the trade because I think that well, we all know they blew out earnings. I think this is a tactic by the market makers right now. If you see a box starting to form downwards here, and it could reach, our stop, that's the only danger that we have, is will it reverse up before it would hit our stop? I think it will, which is why I entered the trade, because I mean, when I entered the trade, it's a lot of money to put into there. So that's options. So I want to explain all the different ways that you can utilize options now. So these premiums are, again, they're huge. Look at these premiums out to February 19th for 150 on the put side. It's $15. Okay, so if I take $150, okay, let's take $150. Go away. If I take $150 and I subtract $14.95. That's $235, okay? So if I sold a naked, and what a naked put is you don't have any of the shares, okay? You don't have any shares of Apple, or you can have shares of Apple. That's irrelevant to this trade. What you're doing is you're saying, and you wouldn't do it with this, by the way, but you're saying I'm counting on Apple to be moving upward, and right now 235, whereas Apple is trading at, I'm sorry, 135, and Apple is trading at 137. So if I sold that put, if I were to go in and sell that naked put, okay, naked just simply means that I'm not using any underlying stock as a protection hedge, right? I'm just going naked, meaning that they can assign me this stock at $150. And for that, I'm getting paid a premium of, let's say, $14.95, okay? So I'm getting paid a premium of $1,495 for 100 shares of Apple, okay? Now, if you were gonna do something like this, you would come down here closer to the actual price of Apple, 137, and the premium is $5.80. If you sold that as a naked put, meaning you are going to be assigned that stock at $137 if the Apple is trading under 137 come February 19th, you're going to be buying it at 137, but you're going to receive 137, $5.80. It's this one, 137. So $5.80 minus $5.80, you will in effect be owning Apple at $131.20. So the naked put just simply means I'm willing to say, I hope the stock goes up and that premium just decays. I want it to become $137. Let's see, even with it being at the money, it's $1.60. So if I had done this trade back a while from January 15th, let's say, and I got $4.80 in premium, or $5.80 in premium, and I'm looking at Apple today, and that 137 is at $1.60. What are you going to do? Are you going to roll the dice that Apple is going to hold at 137 and bounce, or would you have bought back this put for $1.60 into the close, locking in the difference between $5.80 and $1.60? So you would have made $5.80 minus $1.60. You would have made $4.20. Now, if you wait till tomorrow and let this try to expire thinking that I'll roll the dice and Apple drops to 134, guess what? Yeah, you still made the 580. Okay, you're still in at 131, but you just messed up royally on a trade because you should have sold that. And if it does fall off tomorrow down to 133, then go out there to the 19th at whatever 133 would be, which would be back up way up here, okay? And you sell that, okay? But that's a naked put, okay? You can get assigned. So if you're going to trade naked puts for premium gain, what you want to do is come here to Apple and you want to look at this major support. When the worst selling had hit back in those times in October, November, you're wanting to look somewhere between these two marks here. And then you want to come out here and yeah, you're not going to get super rich doing this. But if I look at that and what was the price? Let's say 115 or so. So I look at 115 and it's 49 cents. So I would probably come on out to March 19th and I'd get $1.58. So I'm saying that number one, $1,580 for 10 naked puts is probably pretty good money. And it's probably pretty good odds that a stock like Apple is not going to give me that anymore. At $115, I'm not going to reach that. Even in a major correction, I'll probably get right to it. So that's what you're doing, is you're selling premium. But also something to consider is, would you mind owning Apple for $115 minus $1.58? Would you mind owning Apple for $113.50? My answer would be absolutely not. I'll take it. You give me Apple for $113.50, I'll take it. So that's the odds you're playing. Okay, you're saying that I don't think it's going to reach that. I'm selling this premium, and that's going to decay over time. So as long as Apple is staying above, if it does rally upwards, this is going to really start dropping. Okay, so that premium will start coming to your favor, and you can cash out at any time you want to. So if you look at a stock like a Big C, because it's had such big moves, let's take a look at what the volatility does on a stock like Big C. Okay, look at this. You got Big C right now is at 81, and you've got today, or the 19th, the coming month, you've got $7 at 80 in premium. So at some point, I would say if this dropped down, if this keeps coming, Model T's off that, and that's what you should do, right? Your first thought when you start looking at stocks is, what is the macro trend? Okay, I'm going to pay attention to the macro trend of the stock market before I make an entry. Okay, I'm going to look at the volume that's happening on the stock that caused that, and there's some big volume there, right? That sent that upward up to $97, $98. Okay, so I sold, obviously, a lot of shares when that happened, but I can come here, and if this thing Model T somewhere, let's calculate it real quick. If you guys pull up your own chart, we've got a high of right here. Oh, I can't do that. 96.66. 96.66 plus, here's my explosion move right here. So what is my low? Okay, the low that day is 62.97. 62.97 equals 159.63 divided by 2 equals 79.81. Model T is 79.81. Okay, somewhere right in here is where Model T is. I don't know what was the low today. Let's see. It hit 78.29. Guess what? So it came below Model T. They're day traders. If you're a Model T person and you say after a big run, generally the momentum is still going to be a bounce off of the Model T level. You could have day traded that for a nice gain. Okay, so 79.81 is the number. So, but as this gets down to that 79.81 there, if it falls below that, I start looking at options. And I'm going to come out here and I'm going to say, okay, they're too rich for me to buy calls. I am not going to do that. But I'll go to February, and let's say that it gets down, and if tomorrow's a bloody day and it gets down to $78, $77, then I'm going to look out here, and this is going to be probably around what this is right now, $8.65. And by the way, that's how I also price a lot of my options, is I just simply look at, well, what would it be if it was $5 more or less or whatever? I just look at that and say, well, sheesh, that would be at 11.40 if the stock was down. This is going to be 11.40 if the stock is at 81. So at 80.75, about 11.40, right? Because that's what this is. 81 is giving me an 11.40 price. In the money or right at the money, $8.65 for $80 puts. That's pretty good premium right there. And that would take me down to $72. Okay, 72 would be about right here. So I'm getting close to the bottoms here. I think the bottom's in on Big C. So I think this is just a pullback. So what I'm going to be looking to do is when this is coming down into here, I'm going to look and see how much premium I can get to enter probably a 75. If I can get a 75 put for 850 or more, I'll sell a naked put, and then they can assign me the shares. Okay, you assign me the shares. I'll take them, buy them back again. But if it's a fallback and it bounces now back upwards, then I'm going to earn $8, one call, $800, $850 for one call that I'm going to earn. But you have to have money to buy $100 worth of stock if you get assigned because it fell below $80. Or if you're at 75 and did it at 850, then you have to have the money to buy the stock. So this isn't a tactic for everyone. Okay, a covered call works exactly the same in principle, and we're going to have to end with this one for now. But we're going to have actually a couple of follow-ups because I want to get your feedback on what is not clear still and what we need to spend more time on. But on a covered call, if I'm in the stock, now I would have obviously done this up here, okay? So, but a covered call is simply selling your right to the stock, okay? So I'm basically giving a coupon to buy my shares at $80 to someone, and for that right, they're gonna pay me $8.65 come February 19th because they're hoping that the stock is above $88.65, right? Otherwise, why would they pay me $8.65 versus just going ahead and buying the stock at $81? So, but they don't want to put $8,000 into the market. So they're willing to pay $865 to leverage that 100 shares because they don't have to have the $8,000 behind it. You don't have to have $8,000 to buy the share because this is a pure call option, meaning that if it expires worthless, you're just out $865, end of the trade, or anywhere in between. You can sell it. If it deteriorates to 400, then you know you're like, well, this trade isn't working. I don't know why I bought this option. Then they're going to sell it to someone else who's thinking that $4 is a good value for that option, but you're out. But as the owner of the stock, you're playing the bank. You're being the bank, and you're saying, I'm going to give you my shares for $8.65. They're at $81 right now. That gives me what? It gives me $88.65. So $88.65, which is this. And I probably, you know, obviously I like to get the ask, not the bid, all the time I can. But even at $8.65, that's $88.60. Okay. So the stock right now is trading at $81.27. So that's $7.33 additional profit that I would have made on Big C if it's staying below $80 into February 19th. That goes into my pocket, okay? As the holder of the stock at $60, I now have sold the right to it at $80 for $8.65. And if the stock is falling down back here into the 70s, let's say, I'm going to pocket that $8.65, which comes right off of my entry price. If I bought $60, I now, in effect, am sitting at $52.35 net. I hope that makes sense, because this is an extremely valuable proposition. Now imagine what I did do, and that is I sold when we were pushing here above 95, the options. Well, in the money, okay, those were pushing because it was going upward, and I always tell you I like to sell into buying. Okay, I like to sell my premiums into buying because the premiums are expanding as the stock is moving upward, and you get more premium. They pay an additional amount of premium because they're chasing it. And so if you're selling into that, instead of 925, okay, at this point, if I'm selling it 2 days ago, it'd be more in line with the March probably, okay, right here, 1095 or so. At $90, 95 is $10.30. Yesterday, those premiums were bringing that. I sold those premiums for $10.02 was my average. Okay. Well, today, those are at $6.55. So I sold it for 10 something. I've pocketed $4 already. If I were to reach out and buy this back for $6.55, you pocket the difference between what your covered call, you sold those to someone, the rights to your shares, because the stock fell. This premium, just like Apple, right? We're on the other side of that. If someone sold us Apple calls today that we bought at $2.47, it closed at $1.80. Well, they're up. Okay, people that did that to us, they're making some money right now, and they're probably feeling pretty happy about that for right now. Okay, well, I'm feeling pretty happy about Big C because that's over $4 in profit, or around $4 in profit that I have built into there. And because of this top, I'm probably more likely to say I was willing to part with the shares for the $6. So I was willing to part with them for, I'm sorry, for the $10.40. That would have been $104. So I was willing to part with those shares for $104. I'm still willing to part with those shares for $104. So I'm going to hold on to these and see if they'll decay. Because if they'll decay further in this state, this stock goes through a period like we see all the time of, this is different because it's a downtrend, but the consolidation and this thing goes up. If I'm hitting a consolidation period, these things are going to expire worthless. Okay, that's why we use covered calls. Now I'll use them when I first enter a trade. So I'm going to end with this close. We talked about it, and I tweeted and I posted in the forum when we were completing this cup yesterday. We were completing the cup. Okay, and what happens when you complete a cup? A lot of times it falls back down and creates a handle, and that handle can be anywhere out here. Okay, so when that cup was being complete, I said, good time to be selling some covered calls, guys, because those covered calls yesterday, I did it, so I know it. The 1750s were going for 275. Okay, 275 to 340, I believe was their. Let's look. Okay, 225 was the 8-hour candle. Yeah, okay, 225 was our top. I was thinking 325, 225. So when it was completing its cup, the options for the 1750s, and by the way, we had bought some 1750 calls, right, as well. And I gave you my plan on the stock. And so we reached that to where I had a planned sell of 50 of the calls. So I sold 50 of them. I went out an additional month and I sold 50 of the calls that I owned outright that we had bought back in here. Okay, we bought them here in the 75 cents area. Well, we sold them above $2. So we made great money on those calls. But I also reached out to March and sold the 1750 calls against them. Okay, so against my shares. So now I'm sitting here as the banker again. So I was the guy holding the coupon. I'm holding it right here, and I'm hoping that it's going to complete a cup. It does. It did what I was expecting it to do. So we cashed in, but that cup completion is always a tricky thing. When they complete a cup, you never know what's going to happen initially. So you want to use covered calls at that time when it's completing that cup. Now, you can say, well, it didn't fully complete the cup. Okay, if you're not selling into these tops when they're into the buying, I don't want to catch it exactly at the top. I want to be selling here into the buying. When I posted it, that's when I was taking action, okay? Because I want to be selling into the buying, not as trying to catch it on the way down, because you guys that do options, you're sitting there at a bid of 250, and if the stock tops and drops, suddenly the bid drops to like 230, 225, something like that. You go, what happened? You want to be sellers into the push upwards. You want to be buyers as best as you can into a pullback. And by the way, if you bring up Apple, it was on a pullback when we entered, but the market's turned south on us, and that's going to happen. Okay, so this is Clove. I'm a huge fan of Clove long term. I would definitely be working on trading it using naked puts. I'm in some naked puts, some 1350 naked puts. I'm on those. And again, naked puts, they could assign them to me for whatever the premium is. And since we're at $14 and I use the March, I always go out, I want more premium. If you're going to assign me, go ahead and pay me. They don't even have them there. So it was the 15, it was the 15s, I'm sorry. So the 15s, I got 250. You could get 250 for the premium. I got more than that because they were down here. But I would let them assign it to me, okay? And I want to earn that premium and get my net cost. And it was the 1250s. It's on the post. We sold the 1250 naked puts, okay? That's the ones that you would want to sell because that gets you not only below the low price on this stock since it IPO'd, it would get you way below because the premium of the naked put would be taking your actual net entry price down lower if you're assigned. Otherwise, you're pocketing the money. So it's a combination of all of those things. There's a number of other advanced ways that you can use options that are much less risky. Covered calls I don't consider risky. I consider those strategic. You're going to either lose your shares and make extra money on top because of the premium, or you're going to earn the premium and still own the stock, and you can turn right back around and do it again, by the way. So if you're new to options, understand if you're selling covered calls and you've got a stock moving sideways, you can sit there and do that multiple times. You can let the premium decay to a certain point and go ahead and buy it back, and then go sell the next month's premium back out where you would want to part with it because the premium's higher. You can do that multiple times as long as that stock doesn't get called out. They're still your shares and you're still being the bank. And so I love loaning money at a good interest, and that's what options allow you to do on a covered call. Okay. I knew this would be like a ton of information in a short amount of time. I hope you took notes. This is why this is being recorded, because you can go back and you can back check the, go ahead and use those 1-minute charts that I used. I'll be sending those to you. Go back and look at the dailies and take a look at what happened after that, after each of those signals that I was using. Take a look at what happened on the dailies from there, and then look at your intradays today. You can start going back and do you see any of these patterns that were shown that occurred today? Because those are very tradable. Something else that we didn't do that is going to be very important for us to do is talk about the downside. How do we spot the bearish breakdowns? Because then you want to be buying puts instead of calls. Our Apple calls, we're wanting it to go to 150. If I see a stock that's broken below a key support level, it's going to tank probably. So I want to buy a put somewhere down below that I think that's going to get to. Generally, that's when you have spotted a true correction that's happening. Right now, what we deal with is our hedges to handle that if we do end up with a negative on that. That's all I have for right now. I want you to use the email to email me questions, comments. Again, I'll be posting a lot more content. I'm going to be emailing you a market outlook as I see it, and I'll have to keep updating that as right now it's very muddy. One of the largest portfolios I have is in a whole lot of cash because there is some confusion with all of the macro things that are happening with this AMC and GME and the new administration is executive orders that are impacting the markets. I tend to rein in a lot and move to cash. It's okay to be confused. So now you can take a signal like I'm looking for Apple to kind of lead the way. I think it's a market leader and I'm counting on it to lead the way. So if you see Apple start busting a move upwards, then that's a pretty good indicator for the rest of the market as well. We'll talk more about leading indicating stocks on the detail seminar to follow. So appreciate everyone's time, and we'll be talking to you. Happy trading, and keep your stop losses in check. All right, goodbye.